Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to latest session update for Friday, March 28th, 2025. It's 11:54 p.m. Eastern Time, so plenty of time for me to do this one and get it out to you. I wanted to do one more. May do a post-market wrap, being that it's Friday and a weekend. I'm going to go over some of the replies that I've made to a couple comments, and I encourage you, if you want to know what's going on, go into the site and check the comments from time to time. I'll get to those in just 1 second. A lot of good questions being put up there, and then sometimes I'll post an add-on. I might post a chart or an update on a trade, and then realize that there was something I probably should have added to it. So again, you can come into the site anytime. Just refresh it. Click up here on the header right there. That'll refresh the page. Excuse me. Get a little hoarse here. And then you can see, of course, if there's any new comments down below. I believe that I think I got the subscribe feature working too. When you go down to the comments, if you want to subscribe, this little thing right here, that's follow the user right here. Sticky comment post. Where is it? Subscribe. There it is. Okay, I knew it was somewhere. You can get new follow-up comments, reply to just your comments. If you want to be notified, let me know if you do that and it's not working. I remember for a while there was something I had to do it with the email settings. Every now and then, got to go in, either do it myself or get my programmer to kind of update software on the site. It's always something with technology. Either way, so if you are interested in a particular comment thread or even a particular post, you can subscribe to it that way. All right. Let's dive in here and let me go over a few things. I'm going to start with the VIX. Went over that quite a bit earlier today. This is VIXY, the ETF proxy for the VIX trade. And I wanted to make mention because for lack of a better word, I don't know if I sold it hard today. I just gave you, my take on it, that the RR, is and still is very good despite this, it's up today. But only about 8%. And so what I'm seeing is the market is, and that's why I'm doing this video, this follow-up video, the market's really not showing the fear. So, maybe Tom Lee, for those of you not familiar, he's the latest perma bull de jour. You've always got him out there. A couple of years back, Dennis Gartner. There's always, one that's kind of the perma bull de jour. And it's easy, and, stocks go up most of the time. So if you're just an overtly bullish analyst, you're going to be right more than you're wrong. But come a bear market, right now Tom Lee's calling, as of 3 days ago, for a quote unquote rip your face off rally. And hey, I don't want to get caught short in one. So I replied to somebody today, I'm going to be posting updates. Again, my surgery's behind me. I've got one follow-up on Monday I have to go to post-op. And my doctor, where I've been going for these the procedures recently, is an hour to closer to 2 hours in traffic away each way. So unfortunately, even though it's a short appointment, Monday is going to put me out away from my desk for a better part of the day there. But I will be around in the morning, and I will do a follow-up when I get back. And then, boom, all clear for going forward. So let me dive into this. This is VIXY. This is the 60-minute chart. We had that little clean downtrend line. Of course, the scale-in zone, which I gave you on the daily chart right there. We scaled back into wherever that was. Starting to move up, starting to wake up. And again, in my opinion, a lot more upside potential compared to the downside risk, as I covered earlier. I don't want to, beat a dead horse or up on that. You can check that last video. And now what I wanted to mention is that this is very important. Some years back, and it's probably been, I guess I'm getting old. I've been doing this a while, over a decade now. I'm trying to remember the year, but somewhere after the financial crisis, we had a nice correction, and we were long the VIX. And at the time, the proxy I was using was one of the VIX ETNs. Now, if you don't know what I'm talking about, you can go on the site, go to the FAQ page right here. I'll go to resources, and then FAQs, frequently asked questions. There's a subsection for ETF related questions, which I just clicked on. And then, what is an ETF? What's an ETN? You can read all about it. Basically, an ETN is an IOU, if you will, from usually issued from a bank like Barclays or whoever, whatever the issuer is, and they will use derivatives, fancy derivatives, to try to artificially mimic and track the price of an index. Most of your agricultural commodity tracking things like wheat, corn, soybeans are ETNs. Back in the day, the majority of the VIX tracking instruments, exchange traded products, were ETNs, not ETFs. Now, I am using, if you notice, VIXY, which is an ETF. Inherently, and again, I don't want to get in the nitty gritty. That goes back to you. Read up, know what you're trading. But one of those ETNs, two of them actually, blew up. And I remember that day the VIX soared. It was, again, years back. I'd have to look it up. I actually, at the time, that's what I was using. I wasn't using futures. I've told you over the years I've migrated more and more towards futures trading for various reasons, including tax benefits, safety. Number one, I got burned on that ETF, that ETN back then. It might have been one of these big pops here. I'm watching the VIX take off, and all of a sudden I'm watching my position stop going up, not near what the VIX was doing, and then it started going down. And so what happened is they didn't have the proper exposure hedging on the futures. They had a limit where once the VIX crossed a certain threshold, went up so much, the thing blew up. And so basically you lost not all, but most of your money in there. So I'm throwing out caution through there. So, if you buy Apple, there's no guarantee or minimum how much you can lose in Apple. But at the end of the day, even if there's a market crash, a flash crash, temporary glitch, and, Apple has residual value. So I'm throwing that out to you, and mainly for newbies too, because I just fear that when I sometimes get harping on a trade I like, whether it's natural gas or gold or silver or you name it, or the stock market, or in this case the VIX. I just fear that some newbies might just plow everything they have into that just because that has the highest return potential. So once again, VIXY is an ETF. You can read up. You can go to the issuer's website and read all about it, dig through the prospectus. But just know that, so not only does the volatility cut both ways, but in rare cases, again, ETFs have a lower chance inherently of blowing up because it's different type of, it's structured differently. Those results day to day might be the same, where it's going to track the same price, but I had to throw that out. I think that's important to note, and also because there are still, I believe, if I'm not mistaken, here's one. VXX is an ETN, so some traders might be in that one. And it tends to do, it's going to move. It's also tracking the short-term VIX futures, just like our VIXY. And so the charts look the same. However, again, there may be more inherent volatility. I'll defer that back to you to do your own due diligence on that. So that's it. I already covered it. The targets, and again, if I'm right, where we're at on that map, I like to use when you go to a shopping mall or Disney World, you walk up, there's that board, every so often with a little arrow that says you are here. So if we're at the point in a bear market where I suspect we likely are, after taking out, back testing the 200s and the primary trend line, and we're going to go down, then it could be, if it plays out in that bear flag formation pattern, it could be a relatively swift move. In other words, it took 1, 2, 3, these are 4 weekly candles. So in 4 weeks, we dropped from the high. The entire drop from the high to low was encompassed in a span of under 4 weeks. Remember, these are the weekly candles, go from Monday to Friday's close. So within that 4-week period, the NASDAQ fell 14%. So again, if you think I already addressed the oversold thing, remember, we were oversold on the daily when we went long recently to game the bounce back to the 200s, but not on the weekly, as I mentioned. So if, and again, that's a big if this market wants to drop another 15% in relatively short order in a few weeks, in a month or so, in my opinion, it can do it without batting an eye, because we're not oversold on the weekly chart. And we're also coming off some extreme excessive sentiment, valuation extremes that we haven't seen in many cases decades, or even some hit historical highs. And we have just a new bubble de jour. Back in 1990, in the late 90s, it was .com. Anything with the .com attached to the name, it didn't matter if they had earnings. It didn't matter if they had a good business plan. It didn't matter if they had a competent or even semi-competent management team. If you put the name .com on there, everybody bought it. Same with crypto. Start out with Bitcoin and all these altcoins, or aka shit coins, and so that's that's just one of the bubbles. And then this AI thing. AI, I've spoke many times in the past about that. You guys know my opinion. It's just an iteration, iteration of the advance in technology. It's nothing new. I've talked on that again extensively in the past when the bubble was just ramping up last year. That it's AI's been around for decades. It's obviously starting. We're seeing some advances and some accelerations, but it's especially the things we're using. It's when the large language models came out, LLMs. Everybody thought it was amazing that you could prompt a essay or whatever with a few things, and that's it. So again, technology's here to stay. It always improves. It gets better. Chips, the processing speed continues to advance, but the hype put into these, and especially the big magnificent seven stocks, and the big ones, especially the Microsofts and Alphabets and Metas, that have plowed money hand over fist into that and are still not seeing the returns. Again, I've spoke on that quite a bit in the past, not recently. So those are what I'm talking about, the excesses that when it's more so to me a matter of when, not if, the bubbles pop. But let's not get ahead of ourselves. Right now, this is still a run-of-the-mill correction, but I think, like I said, it looks pretty good so far. We're heading into Friday. As I said earlier, I don't expect a lot of people to gobble this thing up at the close, because if you start buying stocks at the close today, you're going to take them home into the weekend unless you sell them by the end of the day. So I think it's time to grab the bull by the horns and kind of ride it down. Okay, so there it is. Just that kind of thing. I can't give individual investment advice. I no longer work in that capacity. I used to be a stockbroker in my former life, 15-year career stockbroker, before I decided to walk away from that to chase my overwhelming passion for trading. Became a point where the compliance department said, hey, you're trading too much. You're going to run into front running and violations as you're shorting stocks, and then you're going and buying them for your clients. So that's where you can't do both. And I'm glad I did. I had to go devote it full time. I was doing enough on the side, and that's what started my career from transition from selling stocks to individuals to buying them on my, trading them on my own. This is the VIX right here. This is the long-term chart. Again, I already covered plenty of upside should this want to go. And again, we're still we're closer to the bottom of the range than we are to the top of the range, yet with all these sell signals taking place in the market. So what I'm seeing is not only the VIX, that's why I wanted to do this video. I'm seeing the VIX relatively muted, and in my opinion, still underpriced, not pricing in the risk, which also, guys, talks to the sentiment. Again, you can look, don't look at the AII bull bear spread. That's a rhetoric indicator I've talked about. And I've commented on it quite a bit recently. I know there's new folks to the site, so let me just go there and I'll do it and get out of the way. CPC, so these are my sentiment indicators. AII bull bear spread, that's the American Association of Individual Investors. It's a weekly survey they send out to their participants. Are you bullish, bearish, looking forward? And like I say, I call it a rhetoric indicator, meaning you can be foaming at the mouth bullish, just like Tom Lee with expecting a rip your face off rally. But you don't have to buy stocks. Something may change your mind. You may not buy because all of a sudden you see something you didn't see before and you don't buy. Or you're already all in and you might go mark that you're bullish on the survey. So I like to use the put to call ratios, but this survey does have some predictive and even timing values, as I covered recently. You want to see these big hills, these periods of extended bullishness up to my red zone right here. And then it's once you cross down and then folks start getting bearish, that's when the top has come before. You can see these purple lines mark that after the big hills, and it's captured all the corrections. So as I highlighted back then at the time, that so far that did mark the top. Say what you want about it. Maybe this is just a correction and we go to new highs, but we gamed, milk that move down so far. And again, the question marks mean, you see my red box, I think there's probably more to come based on all the other things, the technical posture and everything else. Now the other indicators are, there's a lot out there, but one of my favorite is the CPCE. That's the put to call ratio equity only. So it only measures put to call buying on individual stocks, not the indexes. And I've used this one for many years, and I haven't had to tweak or modify. This is my buy zone when I like to start getting bullish, and that's when everyone else is getting bearish. You see us put to call ratio surge up here. It means a lot more people buying puts than calls. In a bull trend, this is the red level here. You want to start stop chasing longs or start getting short because everybody's bullish. So when you fall real low, it means a lot more folks are buying calls than buying puts. And so we hit that level right there for the first time, as I talked about, since right there, that's when the NASDAQ topped in late 2021. The NASDAQ peaked before the S&P. I just happened to have the S&P down below, but right there is where the NASDAQ peaked. And then the bear market came. And so right there, we hit it. And I always say these are not timing indicators. Sometimes you get persistent readings. And you also don't want to look for the buy signals after a bear market's over. It's normal when a bear market, there's the great bear market that ended in March of 09, and you still get some bearishness after that. You want to see it at the end of a prolonged uptrend. When you see other signs the bull market may have run its course or be getting close to it. And that's what we had right here. And likewise, however, where I'm going with this right now is, so far, as ugly as it's gotten, the fear isn't there yet. There's that Q4 drop. Remember, we were short that high, almost perfect at the top, covered with perfection at the lows. Morning of August 5th, before the market even opened, I fired off a post saying we're covering all shorts, going hard long. And that was when the market reversed in pre-market. By the time it opened up, the reversal had started. And then you can see right there at the bottom, I'm sorry, there's the bottom. That also coincided. That day, we still opened down because the futures were down big at night. I think it was a Monday morning, if I recall. And it was August 5th. And you can see that's when we hit it. That was the last time. So what I'm showing you is there was a lot of fear back here. We were in a bear market, or that big correction, and we were spiking up high, a lot of fear. And each time we had a extreme, that means everybody loads up on puts, and they're shorting stocks, and they're chasing SQQQ and those inverse ETFs. And then you get the counter trend bounce. The public tends to be very contrarian. When everybody else is getting extremely bearish, you want to start getting bullish, whether it's near term or for a lasting bottom. And when everyone else is getting bullish, that's when you got to just erase what you hear on TV. They're going to march them all out there, the bull brigade. They're going to tell you why valuations don't matter anymore, why the market's going to keep going up, why there's no chance of recession in 2025. That's the song they were all singing coming into the end of the year. And that said, hey, if you guys want to think of it very simple this way, when you use these sentiment indicators, always say this. The only predictive value is when they hit extremes, by the way. Extreme high or extreme low. That's why I have the red and green zone. Anything else is just, there's no predictive value. And so the way it works is when everybody's bullish, and again, I'm not speaking literally, I'm speaking metaphorically. When everybody's bullish, that means he or her has bought their last share of Apple. They've committed their last dollar. Their portfolio is fully long. And so there might even be some good fundamental backdrop in the market. But theoretically, if everybody's all in, who's left to buy? And at that point, you only have sellers. Likewise, that's what happens at the end of a bear market. Everyone washes out. Everyone has sold out, capitulated. The last bull or bear has given up and thrown in the towel. And then the supply dynamics change. And you have more buyers because the sellers are just washed out. when you hit that point in the bear market, if everybody, whoever hadn't sold by that point had diamond fists, and they were going to ride it to zero. So the sellers were effectively washed out. All right, that's it, guys. Now, this is an end-of-day chart. This will probably go up today, my guess. You can Google CBOE intraday put-call ratios, and you can get the real-time stuff. They do it, I think, every 30 minutes or hour. You can update it. But I just wanted to say we're not there yet. So, and that formulates, my longer-term opinion. I'd be getting a little more cautious now if we were already firing up there and we had a surge of put buying. Right now, I'm not seeing that. So I'm going to continue to maintain that longer term swing short bearish bias for now. Okay, once in a while I do this, hit the pause button, collect my thoughts, go on to the next one. I don't think I just covered this. I just wanted to point out too that this 100 period moving average I put on here, when it hits this line, typically you can see we hit it right there. That was a 22% drop in the S&P. We hit it here. And so what it does, it smooths out. It kind of shows the trend of the put-to-call, equity-only put-to-call ratio. And that was a 18-month deer market. We had two corrections. NASDAQ fell about 20%, S&P a little less than that. But it went sideways for like a year and a half almost. And then we hit it again there. The top, it's not a timing indicator. The top came a little bit after that, a couple quarters later. And then just now we just hit that again. So that has preceded a lot, including this one, a lot of the bear markets and big corrections in recent years. Okay, guys, so that's the gist of it. This will be updated today. This is an end-of-day chart. My guess it'll probably go up. But again, my point I wanted to bring up is that this was extreme bullishness here. This right now, we're not showing fear. Just like I started out, the VIX is still cheap, in my opinion. It is not reflecting the technical posture right now of the stock market. This market's going to have a hell of a turnaround. I don't favor that. I'm open to it. And if it happens, I will communicate my thoughts. In fact, I'm going to get to some of my replies and talk about, I plan to be very active updating, doing more videos, more updates going forward here. But I just wanted to point this out. So yeah, we'll get a spike today, most likely, with the drop in the market. I'd be surprised if we didn't. But if we didn't, again, it's showing very little fear. This is where you have fear. This is where you have complacency. We're not even close. So, and we're below the 200-day moving averages. So another reason that this, we're going to get, and let me tell you, I've traded a lot of bear markets, a lot of correction. Counter trend bounces are powerful and swift because they're full of short covering rally, dip buyers. But what happens is dip buyers, they're like Pavlov's dogs, or, B.F. Skinner, if you know psychology with the rats, he was the one that would shock the rats if they hit the button, the red button, they'd get a shock, the green button get a treat, and similar. And so what's going to happen is, this has been Pavlovian conditioning up here. Buy the dip, you get rewarded. You buy the dip, dinner bell rings, dogs salivate because they get fed. And then after a while, when they stop getting fed more so, then it starts to become like B.F. Skinner's rats, where they're getting shocked. They're buying the dip, and all of a sudden the dip stops going up, and they keep going lower. They buy the next dip, they get a little rally, they get happy, and then it makes new lows. And then at that point, and we have not hit that point yet. We haven't seen the fear. And in my opinion, that point always does come in a bear market. I call it the POR. It's a nickname I've made up for point of recognition. And, you could see last time around, this was it right here. You had the first leg down, similar to what we have now. You rallied back to the 200s, got rejected off the 200s, started to move lower, and then boom, once they took out those highs, pretty impulsive drop, tried to rally back up, hit the 200s again, big drop there. And remember, this was a very orderly, more of a correction than a typical bear market. I mean, I don't know if you want to look close, the Elliott waivers, maybe there's a P5 cycle, primary 5-way, wave 1, 2, 3 is always the biggest, most powerful impulsive wave for 5. So I guess that meets the definition of a typical 5-wave cycle. But this one, the magnitude of this is, in my opinion, going to be much larger. And, just let's overlay it on my long-term targets here. So that's the measured target. I'm going to get to my questions in a second. Somebody asked me if the measured target of the potential bull flag or bear flag, bear flag continuation pattern, if that's what this was on QQQ. And if it is what that was, it has broken down. You can also look at it daily. I told you on SPY, even on QQ, it seemed a little bit long in the tooth. Not too much when I look at it on the weekly here. And if it is that, then it has broken down. Remember, bear flag patterns have 3 components. They have the first leg down called the flagpole, an impulsive move, followed by a area of bounce on declining volume, and followed by a breakdown. So that's what that would be. So now, and you take somebody asked where it projects to. So what you do on a bear flag, put a trend line from the highest point of the flag to the lowest point, and then take that trend line and add it to the highest point of the flag before it broke down, and that's where it projects to. And so now if you go to a weekly chart, that's the projection. So somebody asked me about this, does it align with any of your targets? So I said, yeah, actually, it comes in just shy of my T2, which we already hit back here. Again, these are the targets I gave you late last year, and we hit T1, T2. This is just the first reaction off there. It would take us there. However, T2 has already been hit. So let me go ahead and read my reply, and I'll read some of the other comments. So anytime, again, you can click on this right side of the chart icon over here, any of the lettering or home, it'll bring you to home. You can see then that any of the updates have been made if you're just keep an eye on the recent post. And so let me just go through these in no particular order. I'll just go with the most recent. Okay, thanks for the video. Okay, I want to just reply. Okay, thanks for your feedback. And I just want to share this with everyone. I'm feeling much better today, and I should be able to remain hyper-focused on the market going forward. I want to get this out there now because Monday's the next trading day after today. I have to go to my post-op follow-up appointment. The doctor I've been going to for this is an hour and a half to 2 hours away, depending on traffic. A couple cities away. I'm in Fort Myers, Dockstown, and Naples. That's a better part of Monday. I'm going to be out. I will be at my desk in the morning. And then of course I'll get any thoughts out there. If I need to get something on Sunday night, I'll do it. And then I'll be back. And even if I don't make it back by the close, I will get if there's anything big, any changes. And that's what I wanted to convey to you guys. So other than that partial day away at my desk, I would love to be Monday. Monday is going to be interesting. Yeah. Anyways, we'll see. I suspect and still favor. I think I don't want to say too much. I think it's my confidence went up today when we didn't break out of the bullish falling wedges earlier. When we took out the last night's lows, and just where we're at now, I think the market's done. I can say with a pretty decent degree of confidence, put a fork in it. But hey, we know this market is driven by this guy right here, Trump, Fed. Guys, I've been doing this a long time. You know this too. The Fed is the most reactive, clueless entity of folks I've ever seen in my life. They're reactive, never proactive. They will come in on a dime and change their tune. I called it in 2018 to the button. We had that big drop. We were short the fourth quarter. It was a huge correction in the market. That's because the Fed started raising rates. I said they will cow down and reverse course. We're going to go long bonds. We did that. We covered our shorts. We went long treasuries. Fed came out because the market threw a hissy fit. That's how I described it. It would be a hissy fit. And Uncle Powell would give the screaming baby the lollipop or the cookie or whatever he wanted. And they did. And they gave the juice back, the free money, started lowering rates again, backed off their plans they tried to start raising rates then. So, anything. Trump's going to, and he's not talking about it now, but we know he benchmarks the success of the market. I'll give him props for, talking a tough talk on all this, what he's doing lately, but he'll cow down too. Powell will cow down if, not necessarily Monday. I'm not calling for that to happen on Monday, but if we go down here and this bear flag plays out and the market drops another 15%, and now all of a sudden we're 30% off the highs, You're going to hear the Fed pull a 180. Whether they say it's due to consumer confidence, they'll talk. Whether they say it's stress in the financial system, but there's a couple other things I want you to watch. And again, I'm going to stay very flexible. There's nothing preordained that the market must or will do. Again, the odds are pretty good that we're going to go down now, especially if we can break the recent lows. Like I told you this morning, we still have the lows to be taken out. They haven't been taken out yet. Probably be more stops there, and then we could get in that kind of impulsive move down, kind of like this impulsive drop we had here. See something like that, but that doesn't have to happen. In fact, look at this. I mean, anything can happen. That's why I do these videos. We go down. If you reverse a hard reversal back up in here, what's that going to do to the charts? I'm going to take this line right here. I'm going to take this line right here. And it's going to give you big positive divergence on the daily chart. And that could give us another run back at the 200s. It's a bit atypical. Usually you kiss them once, get rejected, and that's it. But again, this is almost too easy. It's following the script so closely, almost to the button of what we saw back just in recent history. So a lot of traders are going to be watching this and trying to trade this pattern. And the market just doesn't usually make it that easy. So again, I'm not trying to tell you, this is not wishy-washy stuff. It's just stay flexible. When is the moment to recognize, when do you change positioning if that's your thing? Book profits on the VIX or, some partial, full, or on your shorts. Well, the break of the support in itself will be bearish. It's a reversal, not just a small reversal back test, but a solid reversal back above there. Especially we get back above 480 at this point. Then, and we put in that positive divergence. This is a 60-minute chart right here, but you'd have it on the daily. So those are the kind of things I'll be looking for. Let me show you a few other things I'm watching. Let me get back to the comments here. So, okay, so I will be around full time except for Monday, unfortunately. I wish I could be here on Monday. I think there'll be, if we reverse, it could be a big reversal, or probably going to just see dead cat bounce. Right now, I'm not interested in chase. I'd just be looking to short rallies back to resistance and only concerned if we take out resistance. Let me see what else I have here. So go back home. Okay, let's go to this one here. 6 comments. Okay, somebody asked, is there positive divergence in the index? Is it still valid? Yes, there's still on the 6. Well, when I replied to that, let me check now. Yeah, there is still positive divergence on the 60-minute charts of NQ and ES of the futures. Not QQQ and SPY, by the way. I'd like to see it on both before I make a hard reversal. But you don't always get on both. However, as I often say, divergences, be they positive or negative, are not buy and sell signals. They're merely conditions that often precede a trend change. Okay, so that's a big, big difference. Overbought is not a buy signal. I'm sorry, a sell signal. Oversold is not a buy signal. Those are conditions that often precede reversals, trend reversals. But what you need is a buy signal comes on a breakout above a bullish chart pattern or resistance level, while a case can also be made to go long on a drop to support if positive divergence is in place and the odds favor a reversal versus a breakout off that support level. So keep that in mind. So the bullish falling wedges I posted earlier today would need to make solid breakouts and ideally print a 60-minute candlestick close above those downtrend lines. That just helps you minimize taking a breakout on that fails. We need to print a 60-minute candle close above those wedges. The wedges are more channels now. They're not even wedges anymore. I'll get to them in a second. Neither ES nor NQ broke above those downtrend lines so far today. So let me get to that. There's the wedges. Not even a whipsaw. Nothing. They never broke out. So no buy signal. That's divergence is gone. Well, nope, we still have it. Still there. That's a 15-minute chart. Let me give you my 60. See what that looks like. There's the wedge I gave you this morning, untriggered. Just like any other untriggered bullish or bearish pattern, it doesn't trigger buy. It's not a trade. Drop straight down. Yeah, by the skin of its teeth, we still have some divergence there. So maybe we hold support here and rally off, and that'd be a divergent low. It'd actually be, there's the divergence on the daily. So if NQ makes an equal or lower low and reverses and keeps these divergences intact, yeah, that would be the case for maybe a rally into the close today and or into next week. So, this is not a done deal yet. And we're still above the recent lows, but we did take out that 19,580 level right there. S&P 500, same thing. That wedge never broke out either. This is a wedge I gave you this morning. We just dropped, and then we took out the trend line. Then we took out the price support I was covering in the video at the time. And so that's resistance. And that, if they try to rally it and sell it there and we do that into the close, that's bearish. Obviously, a break below the recent lows is bearish. If they can recover this support, maybe they want to rally it up there, and you still have, let me tell you, 2 resistance levels if you're looking to objectively add to shorts. Take the downtrend line off the highs, as well as that resistance there. That's 57.20-ish right there. And those 2 levels would be objective shorting levels. Also bullish if taken out, bullish if they regain that trend line. Obviously bullish if and as each of these resistance levels are taken out, that further increases the odds we may get a counter trend bounce and maybe even another run at the 200-day moving averages. But right now we're still comfortably above the 200. So with all things being equal, if you're well below the 200s, to me, it says go home short. I might not go home aggressively short. Volatility is high. You go home aggressive anything right now, you're either going to be very happy or very unhappy on Monday. So I usually always tend to take things down a little lighter on the weekends because I don't like waking up to a big gap against my positions. Okay, next question. Does the bear flag measure QQ? I already covered that. That was a great question. Like I said, yeah, the bear flag measures down to my, but let me just read this. Yeah, it never fails to amaze me just how often the measured targets of those bullish bearish chart patterns will align with price targets that I've first come up with. I usually come up with my price targets first based on support resistance levels, the scope of a pattern, the divergences, Fibonacci retracement levels. Then I'll look at the patterns, and quite often I'll add the measured target, and quite often those measured targets come right in line, very close or right on the targets. And so what I went on to say is, yeah, with that bear flag measured down to just below T2 on my weekly chart on QQQ. But remember, we already hit that, and we already had a nice reaction off T2. Again, that's just to reiterate back here. And so therefore, the way it works is, we could certainly go there and bounce again. It's still support. It was. If I had it as support back here before we even hit it, and then we bounced, well, that can only mean that support's even more valid now because that's an additional reaction point versus what I had there before. But with that being said, we've already had a nice reaction, and wouldn't surprise my favor before we get a meaningful reversal that we go down to T3 there, about 413 on QQQ, and I went on to say that. So T2 was already hit at the end of the correction that took us down to the 200-day moving averages on the August 5th lows of last year. Therefore, as we've already had a reaction off the initial tag of that target, while it is certainly possible that QQQ could hit and bounce off that level again, the odds we will get a minor to no reaction the next time around, i.e. will continue down to T3 before a multi-week double-digit swing tradable bounce would be elevated. Elevated to me, elevated odds are just above 50%. If I say high odds, I'm talking 80, 90%. If I'm saying elevated, it's better than 50-50 coin toss odds. Okay, and then at the end of the day, remember there's the other stuff, and that's part of trading a diversified portfolio, with completely uncorrelated assets. Natural gas has nothing to do with the NASDAQ 100 or Mag 7 stocks, and it's just one trade, but even today, I'm sure they're not going to talk about it after the close and the closing bell on CNBC, but we're up, natural gas. We took it yesterday long at support. That was my, after milking it all the way off the lows in 2024, perfect exit. Mentioned reversing it there. Gave you that day we hit that 490 target. final target. So we hit that yesterday to the button, turn around, reverse it, and we're up actually more than today alone. It's up 3.54 right now percent, 3.5% on natural gas, which is more a full percentage more than the Nasdaq 100 is down. So your long on that gas is offsetting. Now that being said, I don't trade. I trade a smaller position size because natural gas is more volatile. So, but it's still a pretty nice gain. And then we took out that secondary resistance level I gave you today. And so that's it. This one I'm just looking to game that bounce. Get in, get out. At this point, you can raise stops, protect profits, or keep a stop somewhere down there if you want to give it a little room. Last but not least, I wanted to talk about Bitcoin. Bitcoin is and has been a active trade idea for a while. We got in a bit early, but there's two things on a trade I define. Again, I make a lot of terms up. On a trade, any trade, I'm either going to be assuming I'm going to be, if I hit my target, close it out, then I'm right, correct. But there's a difference between being early and wrong. This one I was early on. The difference between being early and wrong, early, if I get into a trade and it takes a little while to play out, but I don't exceed my stop loss or any reasonable stop loss, then I'm early. So we shorted this one here on that wedge break, went up, did not exceed the stop, and I said it would have to break this S1 level, and we danced on it. Finally it broke. Then we hit my first, second, and then rallied back. We had a nice re-entry there. Hit third target, which I said would probably bounce because the market was going to bounce and Bitcoin's trading with the market. And then so I covered that today. I just want to say that these are still the targets, but when I look at, I'm going to go to the daily chart of Bitcoin right now and the futures as well. I'm probably going to close that one out. There's a good chance right here around 42 at T4, which is, if hit from where we're at right now, about another 12% drop. We'll see. Right now, let's just keep these targets. Let me go show you why. So when I go to the daily chart here, remember IBIT is one of the more liquid. There's a lot. And when these Bitcoin ETFs got approved, they all came to market. There were tons of issuers lining up. So you pick your poison, whichever one you want to use. I personally trade BRR, Bitcoin futures, but this is the proxy I've used for ETF traders. This one, it's iShares, very liquid, a lot of volume. But you can see here, this was when it came out public, there was that initial drop when these ETFs were issued, then a big run up. And you can see, well, if you can't, you're going to see now my volume at price histogram bars, VAP. This shows you how much volume occurred at each price. And you can see these big histogram bars here. So I'm going to turn it back down, then a thin zone up here. Let me turn that back down and get them out of the way. I don't like busy charts, so I like to mute a lot of that stuff down. Okay, so what this tells me is most people in this security, they bought here. That's what the volume at price tells me there. And so then there was a breakout above that trading range that occurred after this thing went public. Very few bought it here. It was a gap. Not a gap. There was a gap in there, right there, but this is what I call a thin zone. Thin zones are gaps are always going to be a thin zone because no volume occurs. And then very little occurred between there. There's some volume now. So where I'm going is this is a likely target right here, the top of that trading range, and that comes in at 42. Although I'm open to the Bitcoin, I wouldn't be surprised if Bitcoin is worthless in 5 years from now. Wouldn't surprise me at all. I'm not saying it's going to zero, but wouldn't surprise me. So the downside targets are really unlimited. But I just want to say that's pretty good support. So I'll keep you posted. We hit that downtrend line today. And again, this one's going to trade with the stock market here. If you don't believe me, just put the stock market up. There's QQQ. These two trade almost in perfect lockstep. So again, to be long one is to be long the other. Bitcoin's just going to move up and down more in percentage terms. So let me show you a couple other Bitcoin charts, and then I'll show you our sister MSTR trade. BRR, these are Bitcoin futures. Remember, there's a small contract if this one's too rich for your blood. BRR represents a notational value. It's about $420,000 per contract, meaning if Bitcoin goes up 10%, you're going to make 42,000. If Bitcoin drops 10% or whatever, if you're long or short. So that's the amount per contract. And if that's too rich for your blood, MBT is much smaller. I think it's like 1/20th the size. It trades on the same values. So I want to say it broke this minor uptrend line today. These are support levels there. This is just a 6-month, 2-hour chart, but this was a big divergent high right there. And so far, that was the trading range, just like the stock market had QQQ and SPY traded, and that was when it broke down. And then if you missed it, you got a shot back testing, We shorted somewhere in, I don't know, there. The other one is the actual crypto itself. I have a chart on BTC somewhere here. Bear with me. There it is, BTC crypto on the Paxos exchange. It was a divergent high. So there, if we get a rally back up here, there's downtrend line resistance, and there's the bottom of the trading range right there. You can see trading range 91,000. But we just broke down from this trend line there. I just wanted to point out an objective short entry or add-on. If we get there, anything more than that, that's going to be bullish if they break that out. So you might want to have a stop somewhat above there, a little bit out of range, so they don't just pop it and run your stops. And then remember, around the time I threw out, maybe the same day or right after that, Bitcoin gave you a short trade on MicroStrategy. Obviously told you that would bounce. Bitcoin bounce because that's what they do. Load it up. They buy Bitcoin, hold Bitcoin, do whatever else they do. We hit our first target here. The trend, I guess we shorted. Yeah, we shorted right off that bearish engulfing candle. That was calling a high. That's a reversal stick. Usually ends a trend, begins a new downtrend. So far, that seems to be the case. We hit my first target there, second target, bounced off T2, and danced on the downtrend line. Just recently ran into that 340.55 resistance. And so if Bitcoin is going to take another leg down, if the stock market has a big down next week, that should, or within the next few weeks, it should take us down to my third target there, which would give us another roughly 40% drop in MicroStrategy. Right now, I'm going to just add this little target here. And we can even make that the next target. Why don't we do that? I'll just make it official right now. T3 has been revised to 234. And that's for people, and for example, maybe we get down there again, and now we've already hit it once or twice. You know what? Let's not. We already hit it. I'm gonna take that off. I'll just leave it here as is. We hit that level. We bounced a couple times. We'll probably come on down through it. So now T4 was the trend line and or this support level here. The trend line is going to come in first. So there's your final target there. I'll point this out if for whatever reason, if you're in it, you get to 234. Since that defined those recent lows, that is support. But we danced on it for a while. So if Bitcoin has another big leg down, we'll probably come on down and hit my third. And that's now going to be the final target because T4 was the trend line and or 102. So that is now the final target. So let me move that over there. Okay, long video. Let me just make sure I got everything here. Do you think 19,600 is still a good support? No. At this time, I think the next leg down the bear market's likely underway following the recent breakdown backtest and subsequent rejection off the 200-day moving averages, with the nearby support level likely to act as minor. I meant to say with nearby support levels likely to act as minor speed bumps on the way down, especially if QQQ closes down 4% plus today. So again, right now we're down as I speak, 2.67. We're almost testing today's lows. So if we close down 4% or more, that's going to take us down through the lows. And you're just going to have forced margin selling probably at the end of the close. We'll probably finish down near the lows of the day. So I wouldn't be surprised to see a 4 or 5% red close today. Should QQQ reverse hard and print a stick save into the close, I will share my thoughts on how I plan to position over the weekend. As of now, fully short, and I will most likely be going home at least moderately, if not heavy short. But again, I'll see how the rest of the day unfolds and how the charts on the indexes, key sectors, Mag 8, VIX, put-to-call ratios, Treasury bonds, investment grade and corporate bonds, etc. look as we head into the close. And this is going to wrap this video up. I'm going to look at bonds real quick for you. LQD and HYG are the two big junk bond ETFs. SJB is an inverse short junk bond ETF. I actually have a position here, and I added to that today on the shorting junk bonds and some longer term accounts. You can do that in an IRA. Not that I'm telling you to short or do anything in an IRA, but that's one way to short in an IRA. Either you can short futures if you have interactive brokers. They'll let you short futures in an IRA, which is a great way to profit in a bear market. But most brokers, you're going to have to buy an inverse ETF. So far, they aren't getting hit as bad as the drop in the stock market suggests, meaning the credit spreads are really spiking. Gosh, I had a ton of typos here. Credit spreads aren't really typing. I'll fix all those typos yet, although they have certainly been widening lately. If and when credit spreads start to really blow out, that is when the stock market is likely to really start getting hit hard. For those of you who don't know what I'm talking about, credit spreads are the differential between what safe U.S. Treasury bonds and below investment grade corporate bonds pay. These are credit spreads here. This is one of many. You can go on Fred. There's a lot of sites. That's the St. Louis Federal Reserve. And you'll see these are the recessions that we've had in recent decades, including COVID. And you can see credit spreads start to rise during and into a recession. This is where they really blew up in the financial crisis, and in COVID they started going up. Over the years, they've been trending lower because of the excessive intervention in the financial markets and the backstop by the Fed, zero interest rate policies. So they have been moving up since COVID, but they're still at historic levels. So I'm watching this. That's one thing I watch closely. And you're not going to have that outright crash in the market. Usually the credit spreads will give you a heads up first by starting, and they have been ticking up recently. Don't get me wrong. See, they've been moving up here since last October, zigzagging up. So we'll watch this closely, pop that, and once that starts to happen, things happen under the hood in the financial markets. Trust me on that. What happens? A lot of things happen. Or investment grade bonds, LQD. People think these are safe, and they typically are. These are bonds rated, investment grade, which is triple B or higher. And you have what happens is a large amount of issuance are at, I believe it's triple B, it might be double B, it's been a while. You have a lot of issuance at the lower end of the investment grade spectrum. And so as the economy starts to turn, which will happen when the stock market drops, you get those bonds get downgraded to what is known as junk. It doesn't mean they're completely junk. They're still paying interest if they're not in default yet. But then they, by proxy, by prospectus, LQD and these investment grade corporate bond ETFs and mutual funds have to sell those bonds out because they can only hold investment grade, and it has a cascading effect on the markets. And when COVID hit, they stepped in and they bought things like the Fallen, which these were on the verge of bonds that were junk recently moved back up to investment grade, but they're just right on the verge. So I'm watching things like this. When I start to see these drop, LQD, which is junk bonds. LQD is investment grade, but I'm watching that trend line, and I'm watching the price performance between junk bonds, which you can see lately. See this moving down, which was what they usually do with the stock market. However, they're not showing real signs of distress yet. I think when we break this support level, you'll start to see that. And if you see junk bonds like JNK and the other one I'm going to show you here in a second dropping and treasuries going up, that means credit spreads are widening, and that's usually a bad sign for the stock market. HYG, going from memory, yep, that's the other junk bond ETF. And so I'm watching these closely, and then you compare it against TLT or IEF. IEF is a good one to watch. So you can see treasuries have been bidding up as a flight to safety bid lately. Treasuries in this little trading range right here. And again, you can either just chart or keep an eye on junk bonds and investment grade bonds. That's one thing I'm watching. So far, we're not seeing the bond market showing extreme signs of duress. But again, they are trending up. Credit spreads are starting to widen, as they should be, in my opinion, they're not reflecting what I'm seeing in the charts of the stock market as much. So I would be even more bearish if I start to see credit spreads start to blow out. And I suspect they will at some point this year, but we're not there yet. Okay, guys, long video. And when that happens too, VIX should take off and really start to soar. So that's the one thing giving me a little bit of pause right now, just seeing how junk bonds are, they're down today, but of course stock market's down pretty big. Junk bonds, if they were down a lot more than that, would further support the case to be go home short over the weekend. So I'm going to set a price alert right there. All right, guys, I'm going to wrap the video up, get it out to you. If you have any questions, follow up in the comment section. I'll try to get back to you as soon as possible. This has been Randy Finney with Right Side of the Chart. Have a